Welcome back to our deep dive series. Today we're digging into the Q2 FY26 results for Mahindra Logistics Ltd, or MLO.
That's right.
And for anyone following the logistics sector, well, you'll know this quarter wasn't just about growth figures. It feels more like a story of strategic change, wouldn't you say?
Oh, absolutely. It's a pivot, a really significant one, away from just rapid, sometimes maybe costly expansion towards disciplined operations, locking in efficiency, and critically working on improving those margins for the long haul.
Okay, so our mission today, cut through the numbers and find that narrative, how MLL is executing this big shift.
Exactly. And the period we're looking at is the quarter ending September 30, 2025. You have to remember, this comes right after their big 360-degree review last quarter.
Ah, right. So this is the first real test of that new strategy.
Precisely. It's the proof point. Is the new focus on, disciplined, profitable growth actually working? The mandate is clear across the company now.
Got it. Okay, let's unpack this then. Where should we start? Probably with the biggest shockwave, financially speaking.
Definitely the financial foundation. I mean, the debt overhaul this quarter. It wasn't just tweaking things.
No, it sounds like they hit a giant reset button.
Pretty much, yeah. The absolute bedrock of Q2 was that successful rights issue back in August 2025.
And that was a big one, wasn't it? How much did it raise?
Massive. Rs 749.27 crores. And the impact, well, just look at the debt. Consolidated debt obligations went from Rs 601 crores at the end of Q1 down to just Rs 73 crores by the end of Q2.
Wow. Okay, hold on. That's, what, nearly 90% wiped out in 3 months?
Just about, yeah. An incredible reduction.
And for you listening, think about the long-term impact. Shedding that much debt, well, frees up serious cash. Right?
Enormous impact. They're expecting annual interest cost savings somewhere in the range of Rs 40 to 45 crores per year.
40 to 45 crores annually. That's not just a one-off gain. That's permanent financial breathing room, capital they can reinvest.
It completely changes their financial position, moves them away from that sort of cyclical debt pressure towards genuine long-term stability.
Makes sense.
And while we're on the cleanup, there's one other small item, a one-time charge, Rs 4.8 crores.
Okay, what was that for?
A provision for doubtful debts, a PDD. It was linked to a specific 3PL customer filing for bankruptcy.
Standard accounting practice then? Or is there more to it?
It is standard, yes, but the timing is telling. Management chose to take that hit now.
So clearing the decks completely.
Exactly. It signals they want this new strategic phase to start with a totally clean slate. No old baggage dragging down future quarters. It shows, a real commitment to transparency and financial rigor.
Rigor, that's a good word for it. And it brings us neatly to the operational side. With the balance sheet stabilized, the focus shifts, right?
Right on to plugging leaks in the P&L, operationally speaking.
Yeah.
That internal review set out 3 main pillars.
Which were?
1, excellence in execution. 2, disciplined cost optimization. And 3, a really sharp focus on site-level economics, getting each warehouse profitable.
Let's talk about cost optimization first. That white space issue they tackled.
Yeah, white space is a killer in warehousing. It's basically paying rent for empty, unused space. It's just burning cash.
And they made it a top priority.
Absolutely. And they moved fast. In Q2 alone, they cut their total white space footprint by over 20%.
20% in 1 quarter. That's aggressive.
Very. And it shows they're serious.
But they didn't stop there, did they? The target they set is, well, it's incredibly ambitious.
It really is. They're aiming to cut the rental cost associated with white space by 95% by September 2026. 95%.
95. That leaves almost nothing. Are they basically saying they expect demand to perfectly match their capacity?
Pretty much. They plan to hold maybe just 5% for, unexpected, urgent customer needs. It's a huge bet on their forecasting and future demand, sacrificing flexibility for potentially massive long-term margin gains.
Okay, but there's a bit of a contradiction here, isn't there? Or at least something that needs clarifying. They're cutting white space costs, but overall rents went up year on year.
Yes. That's a really critical nuance. It sounds counterintuitive, but it makes sense when you look at the investment cycle.
Explain that. Why are rents up if they're shedding empty space?
It's because of prior long-term commitments they made for new, large, built-to-suit facilities, BTS warehouses.
Custom builds for specific clients.
Exactly, tailored for high-value contracts. So the cost hits the books now because The leases are active, but the revenue from those big new sites hasn't fully ramped up yet.
So they're paying the mortgage before the tenant is fully moved in, so to speak.
That's a good way to put it. Like the big new 3 lakh square foot facility in Nashik or the new hubs in Guwahati and Agartala. These are strategic investment.
Right.
Management basically sees Q2 as the peak for rental costs. As these new sites get fully utilized, the revenue catches up, and that overall rental cost as a percentage of revenue should come down significantly. It's temporary inflation from necessary investment.
Okay, that context is a really helpful, thanks. Now let's shift gears a bit. Let's talk about the express business. MESPL Revigo. That's been a tough nut to crack since the acquisition, hasn't it?
It certainly has, and it's so crucial for their overall vision of integrated logistics. Turning it around was, well, a major focus.
And this quarter, there was a big development there.
This is, I think, the standout operational win. For the first time ever since the acquisition, the express business hit positive gross margin territory.
How's a GM?
Really? Now, it was 0.2%, which, okay, sounds tiny.
Yeah, 0.2%. Is that really an aha moment, or are they just setting the bar low?
It's a fair question. But the significance isn't the number itself, it's crossing the threshold, moving from red to black.
Psychologically important.
Hugely. And financially, it shows the underlying operational discipline is finally taking hold. It wasn't just luck. Volume grew too, up 7.2% year on year.
Okay, so it wasn't just cost cutting. There was actual growth supporting it. But how did they get the margin positive? Was it purely volume?
No, it was about yield, getting paid more for what they move. Management reported that yield revenue per kilogram is up by about 90 pays so far this year.
Ah, so they're being more selective, focusing on better paying customers and routes.
Exactly that. Optimizing the customer mix, prioritizing high volume, high yield lanes, not just chasing any business to fill trucks, quality over just quantity.
And they're backing this turnaround with more cash.
They are. Another R50 crores of equity capital is going into the Express subsidiary, MESPL. The goal now is to push it towards being EBITDA positive. This investment says management truly believes the corner has been turned.
Right. There was an analogy used in the source material, wasn't there? Comparing it to something.
Yes, the airline industry, which I think is quite apt, actually.
Yes.
Well, think about launching a new flight route, say, Mumbai to Singapore. It's not profitable on day one, right?
No, definitely not.
You have to build passenger volume, optimize cargo, tweak pricing, get the schedules right. It takes time, investment. They're basically saying the Express business plane has finally achieved liftoff, generating positive gross income. It's past that initial, really expensive startup phase.
Okay, that analogy really helps clarify the achievement. Makes sense. Let's broaden out again. What about the rest of the business? Because the overall picture looked pretty solid too. Consolidated revenue up 11% year on year?
Yes. This 1,685 crores. Strong growth. And it shows that the operational rigor wasn't just in one corner. It seems to be across the board.
Particularly during the peak season.
Especially then, yeah. Look at the core 3PL and warehousing segment. Revenue there grew about 20% year on year, hitting crores 333 crores. And that wasn't just growth, it was handling massive surges.
You mentioned some specific examples.
The numbers were pretty staggering. During the festive peak, one grocery fulfillment center processed 8.2 lakh units in a single day.
8.2 lakh units.
Wow. And another big center hit 13 lakh units in one day. These were best ever performances. Handling that kind of volume smoothly points directly to that focus on site-level execution we talked about earlier.
Impressive stuff. Meanwhile, the freight forwarding arm, Lords, was dealing with a tougher global environment.
Yeah, all the known headwinds, geopolitical issues, volatile cross-border pricing. It's a difficult market.
But they still grew.
They did. Volumes up 9% year on year, which suggests, their diversified client base and their expertise in navigating complex global supply chains are providing a good degree of resilience. They're managing the volatility well.
Okay, let's look at the customer-facing side now. Mobility seems to be doing really well. Revenue up 16%.
Yeah, to almost ours, 94 crores.
Yeah.
And they're expanding the service offering there, too. The big news was launching Elite Prev.
That's the premium B2C service.
Exactly. Launched in Delhi NCR, targeting that higher-end consumer market. And apparently the reception has been phenomenal. They reported a 99% five-star rating.
99%. That's basically perfect. Suggests very strong quality control.
It does, even while expanding into potentially more demanding markets.
Okay, one more segment to touch on. Last mile delivery, Wizard. Significant revenue growth there too.
Yeah, RS 68.4 crores compared to about 51 crores same time last year. But the real story there wasn't just volume, it was defending margins.
Because last mile's always under pricing pressure from customers.
Constantly. It's the nature of the beast. But MLL didn't just accept lower margins. They actively renegotiated and managed to restore margins compared to Q1.
How do they manage that? Better service.
That seems to be the key. They use their operational quality as leverage, and they have proof points for that quality.
Like what?
Well, during the quarter, they picked up awards like Best Large Partner for South from Amazon and Best Pickup Champion from Flipkart.
Ah, so getting recognized by the biggest players gives you clout in negotiations.
Exactly. When Amazon and Flipkart say you're doing a great job, it gives you a much stronger position to hold firm on pricing and protect those margins, which is what they did compared to the previous quarter.
Okay, so let's try and tie all this together. Looking at Q2 overall, what's the main headline for you?
I think the headline is growth driven by discipline. You've got solid top-line growth, that 11% revenue increase. But crucially, it's underpinned by really rigorous internal changes.
The debt reduction, the white space cuts.
Exactly. And getting Express to positive GM, it's not just chasing volume anymore. It feels like a company transforming itself from the inside out, and it's starting to show results.
So looking ahead, what does this signal? The focus is clearly different now.
It's shifted, yeah. Less about just getting bigger, more about getting better. Yield improvement, operational excellence, optimizing the entire network. It's all positioning them, as management said, to be the best integrated logistics company of India.
A clear ambition.
It is, and it raises an interesting final thought for you, the listener, to consider. MLL has an asset-light model, and they're really pushing sustainability, aiming for carbon neutrality by 2040, expanding their EV fleet, over 1,500 vehicles now.
Right, a strong domestic and sustainable focus.
Exactly. So, given all that, and considering the ongoing global uncertainty, trade tariffs, geopolitical risks, how might that impact their strategy? Does it mean their increasing reliance on domestic resilience becomes even more critical?
Will global headwinds force even the best integrated players to double down on the stability of their home market?
It's definitely something to think about. How much can domestic strength insulate them from global volatility?
A very pertinent question indeed. That's a great place to leave it. Thanks for walking us through this. It was a really insightful deep dive into MLL's transformative quarter.